Welcome to Accounting 101, Chapter 4, supplemental video lecture. I believe on the first one I forgot to talk about the classified balance sheet, which appears in the beginning of the chapter. I apologize for that. Again, it's my inability to turn pages in the electronic textbook that I use when I'm at home. It's a delay, so I'll tap the arrow to turn the page a second or third time when nothing happens for 4 or 5 seconds, and it ends up turning 3 or 4 pages for me. So again, chapter 4, completing the accounting cycle. Really, the main topic in chapter 4 is the closing process, but to, I guess, make it of consistent length and duration, they throw in this thing about the classified balance sheet. Up until now, we've seen the balance sheet, and we know what the balance sheet is: a statement of the assets, liability, and equity accounts of a business, and that they must balance. We've done these and we've seen them in chapters 1, 2, and 3. Now we're going to do it a little bit more detailed, where we're going to do it according to classifications. The asset section of the balance sheet now is going to have four possible categories or classifications. Okay, before we just had assets, we're still going to have assets. It's still going to have a shell with assets, liabilities, and equities. But now in the assets, we're going to have a further breakdown by category. And there are, like I said, 4 of them. The first one being current assets. The second category is what we call long-term investments. The third category is what we refer to as PP&E, which is the acronym for property, plant, and equipment. And then the fourth category for assets is called intangible assets or intangibles. We'll talk about those after we come back. Just a short intro on the liabilities. Liabilities now are going to be shown into 2 categories: current liabilities and long-term liabilities. Okay. Equities are not affected. We're still going to have common stock and retained earnings at this stage of the game. Later on, we'll have a added equity account called additional paid-in capital, but that's at the end of the semester in Chapter 13. So no responsibility for it at this point in time. So on page 4-5 and 4-6, they talk about each one of these categories, a couple sentences. And also the margin on page 4-5 have all the definitions you need to know. And hopefully they are on your shell outline. Okay. Now, current assets are and current liabilities are any assets or liabilities that are going to be have a life expectancy of less than 1 year. Okay, so it's an asset that's going to be used up or consumed within 1 year, or it's a liability that is going to be paid off or satisfied within 1 year. Actually, I should say 1 year or the accounting cycle, whichever is longer. In my 50 years of accounting, I've never seen anything longer than a 12-month year or accounting cycle. But that's the rule. There may be out there, I just have never encountered one. So in the current asset section, we're going to list assets in order of liquidity. Liquidity is defined as how quickly something can be turned into or converted or realized in cash. And so by that definition, the most liquid of all assets is cash. And that'll always be listed first. They show you a classified balance sheet on page 4-6. The second one they list there is under current assets is accounts receivable, followed by office supplies, prepaid rent, and then they have total current assets. There could be other ones. We'll see in chapters 5 and 6, we get introduced to a new asset account called merchandise inventory, or just inventories for short. That'll also be considered a current asset. Okay. Remember in the one exercise in chapter 3, I forget if it was a short exercise or an exercise, there was an insurance, a prepaid insurance plan for 24 months. So that asset would have to be split. The amount of that prepaid asset that is going to be consumed within the next 12 months would be shown as a current asset, and the last 12 months of that insurance policy would be shown as a long-term asset. Okay. probably as an intangible or possibly, I don't think, well, I would have I don't think it'd be a long-term investment. So probably either as an intangible. They used to have a fifth category when I was an accounting student called other or miscellaneous. Sometimes you'd have to put that in, I guess. All right. Again, liquidity is how quickly something is going to be converted or realized uh, in cash within 1 year or less. Long term is anything that has a life expectancy greater than. So if it's 1 year, it's current, or less, it's current. Over 1 year, it goes into the long term category, and then we have to put it as investment, property, plant, and equipment, or intangibles. Okay. So again, assets are those things that help us generate revenues, and the category classifying them, putting them into these four classifications, help with the communication part of the definition of accounting. Long-term investments are investments that management expects to hold for a period of greater than 1 year or the accounting cycle, whichever is longer. And that would be, use the example. You can also have investments that are short-term investments. They would be shown under current assets as marketable securities. In chapter 10, I believe, we will be studying investments up close and personally. And we'll see that management intent when they buy the asset is what governs whether how it's handled and treated and classified. For instance, a management could buy 100 shares of SmithKline, what's it, Glaxo, the pharmaceutical company, 100 shares. They could say 75 are going to be long-term and 25 are going to be marketable securities, short-term investments. So they just have excess cash. They want to earn some market appreciation, maybe some dividends, and the other is long-term investment. Okay. Property, plant, and equipment. We'll see this a little bit more detail in Chapter 9 when we study depreciation, amortization, and depletion. These are assets that are referred to as long-term assets. Property pertains to land, real estate. Plant refers to improvements on real estate, buildings, land improvements, parking lots, sidewalks. Equipment is the default category for anything that is not land or real estate. Equipment, therefore, means any personal property that has a life expectancy greater than 1 year. Furniture and fixtures, machinery, tools, vehicles, excuse me, and the like. They will all be subject to depreciation. So sometimes they're referred to as depreciable assets. Sometimes they are called fixed assets. Sometimes they are called long-term assets. Now the book says also called fixed assets or plant assets. Again, they're also referred to as long-term assets or depreciable assets. Okay. Each one of those, except land property, will have a associated accumulated depreciation account with it. And let's see, land is being presented first, and then buildings, and then equipment. I kind of have a problem with that. That is the customary way of doing it. That is in inverse order of liquidity. If they want things listed in current assets in order of liquidity, why do we change it around for property, plant, and equipment? I guess because the name property comes first. They could have made it equipment, plant, and property. It would be logical, and that would be the order in which their liquidity appears. Equipment, 5 to 10, 15, 18, 20 years maybe. Plant, a building can last you 20, 30, 40, 50 years or longer. And land, it's here now, it's going to be here centuries from now. Okay. The fourth category, intangible assets, covers assets and pertains to assets that have no physical characteristics. These are things like patents, copyrights, things that give you a legal right. And again, Keep in mind that a patent can apply not only to a composition, but a process as well. And again, more on that in Chapter 9. Copyrights, patents, what else would go in there? Franchises, goodwill. There's a whole bunch of things that would fit the trademarks. And when we're going to look at them in Chapter 9 a little bit more in depth, we'll see that we are more concerned with their economic life than their legal life. Okay. Liabilities, as I said earlier, there's two categories. So we have current liabilities and long-term liabilities. The only tricky thing here, the rule is the same with the assets. Anything that is 1 year or less is going to be classified as a current liability. Anything that is going to be realized or satisfied in a period greater than 1 year is going to be classified as a long-term assets. The one curveball here is if you have a long-term loan, a serial loan, like a mortgage, a 15-year mortgage, which is a typical commercial time frame for a mortgage, that would be 180 months. So in the first year, payments 1 through 12 will be shown as current portion of long-term debt under the current liability classification on the balance sheet. Payments 13 through 180 would be shown as long-term debt under mortgage payable, note payable under a long-term liability. The second year, payments 13 through 24 would be shown as current portion of long-term debt, and payments 25 through 180 would be shown as a long-term liability, so on and so forth as you roll forward through the calendar years. Okay. If you look on page 4-4, figure 4-2, we see the income statement, statement of retained earnings, and the balance sheet for Smart Touch Learning into the simplified format. Again, the one they showed there is for the balance sheet is the report format. The only place I've ever seen it in my life is in textbooks. The report format would have the liabilities and equities listed under the assets in one vertically. It wouldn't have the two sides. Now, if you look over on page 4-6, exhibit 4-3, there's a balance sheet for Smart Touch Learning for the same date, December 31, 2024. And that is your classified balance sheet. Notice the total assets, $113,550 on the simplified one on page 4-4, agrees with the total assets on the classified balance sheet on page 4-6 in exhibit 4-3. It doesn't change the total amounts. It just gives a more detailed arrangement and format. Okay. Look, we have 1, 2, 3, 4, 5, 6, 7, 8, 9 accounts listed under the assets. We still have 1, 2, 3, 4, 5, 6, 7, 8, 9 accounts listed under the assets in the classified balance sheet, but we have them broken out by subgrouping. Current assets, property, plant, and equipment. So they only have 2 of the 4 possible categories in this example. And again, you have the intermediate breakdown under assets. You have current assets, and they're listed there. Then you have property, plant, and equipment, and then you list all of them there. Notice on page 4-6 in exhibit 4-3, the format, the presentation of that balance sheet. Just the upper half I'm looking at now. The current assets are listed. There's like 3 columns of figures. Okay. So the middle one is a detailed. It lists all the current assets, and then the total is shown in the right-hand column. Total current assets, $16,100. Then you have property, plant, and equipment. They start off in the left-handmost column, column A or 1 if you want to call it, and they list the amount of the building, less its accumulated depreciation, and bringing the subtotal over to the middle column. As we'll learn in Chapter 9, and we saw in Chapter 3, that the cost of the asset less its accumulated depreciation is referred to as its book value or carrying value. So right in the presentation, there's a lot of information there if you know how to read it. we can see that the book value is $59,750, and we can look to the left column and see, oh, the original cost of the building was $60,000, and it's got a $250 accumulated depreciation. I can tell, because I have some experience with this, that building is relatively recently purchased. I'm not saying it's a new building. It may well be a new building, but it is a new building to Smart Touch Learning. They could have bought it from somebody else as an existing building, but they got it at $60,000 purchase price, and it has been acquired relatively recently because there's not a whole lot of accumulated depreciation associated with it. Same thing with the furniture. They came in at $18,000, and it only has $300 of accumulated depreciation on it, and its book value is $17,700. Again, I can tell that the furniture is newly acquired by Smart Touch Learning. If you recall back in chapter 1 and 2, when they went over the detailed transaction, Ms. Sheena Bright, the owner of Smart Touch Learning, contributed furniture she had to the company in exchange for taking out common stock. So it's not new furniture, it's used, but it's new to Smart Touch Learning, and it's relatively recently purchased. You can make an assumption that it's relatively new and doesn't have to be replaced very soon. Okay. And again, you have a very low accumulated depreciation with those two assets because the company has only been in existence for 2 months, November and December of 2024. So then you summarize the middle column under the property, plant, and equipment category. You got the $20,000 for land, the book value of the building and furniture, respectively, at $59,750 and $17,700. You total those, and you have a total for property, plant, and equipment. And then that's added to the total current assets for a total assets of $113,550. Again, the presentation, depending on who's looking at it and what their needs are, they can focus in on what the current assets are, how much is the property, plant, and equipment. If they had any long-term investments, they could see that. They could see the intangibles if they had any. They don't have any long-term investments. They don't have any intangibles here, so they're not presented because they don't have any. Again, if you were interested on their investment portfolio, you could see the total of it. Then you could go look to the left and see if they had enough room, they could list the individual stocks, or they could refer to a schedule in the notes to the financial statements listing each individual investment they have. All right. Moving down to the liability section, you can see we have the current liabilities, and there's 1, 2, 3, 4, 5 individual accounts listed, and then the total of the current liabilities. And then long-term liability, they only have the one, the note payable on the building. So those are combined in the right-handmost column for total liabilities. All right. Stockholders' equity, you have the common stock plus the retained earnings, and then you have total stockholders' equity, and then that's combined with the total liabilities to get to $113,550, which agrees with the total assets. Again, that's why it's called a balance sheet. Those numbers must equal, they must balance. And again, if you flip back to page 4.4, you can see that the total liabilities in the simple balance sheet in Exhibit 4.2 agrees with the total liabilities in the classified balance sheet, and same thing with the equity, same thing with the total liabilities in stockholders' equity. The numbers don't change. It's just now in the classified balance sheet, we're breaking them out into different classifications, giving the user a little bit more detail. Okay. They also talked here at the beginning of the chapter about the relationships between the accounts, between the financial statements. I have covered that multiple times since the beginning of the semester. Net income, the income statement has to be prepared first, always and forever, because we need the result of that to do the statement of retained earnings. We need the updated retained earnings balance to do the equity section of the balance sheet. Okay. Again, I've also talked about some of the relationship in chapter 3 about how important it is with the accrual and deferred amounts, how they're taking certain things off the balance sheet, off the top of the balance sheet, assets and liabilities, unearned revenue and prepaid items and depreciable assets. taking them over to the income statement, working down and to the retained earnings statement, and then coming back to the balance sheet, but down in the equity section of the balance sheet. Okay, so it's taking them from the top under the asset and liability section. They go over to the income statement, filter down, and then they come back to the balance sheet in the equity section of the balance sheet, the very bottom of the balance sheet. All right, so I think that's about where because I think I did talk about that worksheet on page 4-8, exhibit 4-4, and how that works. So I think that's all I had to do, a short little one here to make sure I cover that material for you folks. All right. That's what you like. If only they were all only 20 minutes long, huh? So we'll be getting another one out later this week for the solutions to chapter 4. So watch for it in your emails. Oh, I'm not in my house. I'm in my office here. That's why the background is different.